Welcome back to Investing Talk Podcast. Today we're tackling a company lots of you have been asking about, Sequans Communications. The big question, really, is it a good time to buy now? We're going to break down everything you need to know. We'll look at their business, the financials, what the market's saying, and importantly, the risks involved. Our goal is to give you a clear picture, so you can make informed decisions. Before we dive in, though, just a quick ask. If find these chats helpful, please hit subscribe, like us, maybe leave a comment. It really does help us keep this going. And hey, if you feel like it, you can always buy us a coffee. The link's below. Oh, and if there's a company you want us to look into, drop the name in the comments. We do read them. Okay, let's get started. Sequans Communications. What exactly do they do? Why are we even talking about them?
Right. So Sequans Communications, they're what's called a fabless semiconductor company.
Fabless.
Meaning they design the chips, the integrated circuits, but they don't actually manufacture them themselves. They outsource that part. Their real focus, their specialty, is on 4G and 5G connectivity solutions, specifically for the Internet of Things, or IoT.
Okay, IoT, that's a huge space.
It absolutely is. And if you think about the bigger picture, the IoT market is just booming. Everything from smart cities, connected cars, industrial gear, even health wearables.
Yeah.
They all need to connect. And Sequans focuses on cellular IoT, which is a strong niche because it offers wide coverage and, a better security than some other options. So potentially a really strong position.
Got it. So they're making these specific connection chips for this massive growing IoT world. Makes sense. Okay, so let's look at the numbers then, the financials. Some of these figures really stood out. Trailing 12 months revenue, about $38.86 million. Okay, but then net income, $62.1 million.
Yeah.
That gives a net profit margin of like 160%. That sounds, well, amazing, but also kind of surprising, right?
It does. It sounds almost too good to be true, frankly.
And their gross margin is strong too, nearly 75%. Plus, analysts are forecasting around 32% annual revenue growth. How do we square that 160% profit?
Well, that immediately raises a big red flag, or at least a yellow one. 160% net profit margin, where profit is higher than revenue, almost always means there were significant one-time gains. It's very unlikely to be from their core operations, selling chips. It could be from selling off patents, a big settlement, maybe some kind of financial engineering, something unusual.
So not sustainable profit from the actual business.
Probably not, no. You really need to dig into why that number is so high. The gross margin, nearly 75%, that looks healthy. It suggests they manage their production costs well. But that net profit figure, you have to be cautious about the quality of those earnings. Understand where that $62 million actually came from.
Okay, important distinction, so maybe a one-off boost. What about their foundation, the balance sheet?
Yeah, looking at the balance sheet, there's some good news. Sequans has no debt.
Oh, that's great.
It is, especially now. A clean balance sheet is a big plus. But here's the other side of that coin. Their cash flow from operations. Historically, it's been pretty weak. If you look back over the last 5 years, it's only been positive sometimes, kind of sporadic.
Inconsistent.
Exactly. And while profit looks good on paper, positive cash flow from operations is what really keeps a business running day to day. It shows if they're actually generating cash from selling their products. That inconsistency is definitely something you, as an investor, need to factor in. It raises questions about long-term sustainability.
Right, profit versus actual cash coming in, a critical difference. Okay, let's shift to valuation now. How is the market pricing this company? This gets even more interesting. Their price to earnings, the PE ratio, is incredibly low. Sources show it somewhere between 0.92 and 4.6.
Yeah, tiny numbers.
Tiny, especially when the average U.S. market PE is, around 18 or 19? This just screams undervalued, doesn't it?
Yeah. On the surface, yes, absolutely. But again, we need to be careful. Why the big range, 0.92 to 4.6? That likely depends on which earnings number is being used. Trailing earnings, forward estimates, adjusted for those one-time gains we talked about.
Ah, so that huge profit could be making the PE look artificially low.
Precisely. If the E in PE is inflated by a one-off event, the ratio looks much smaller than it really should based on ongoing operations. So yes, it looks cheap, but why? That's the key. Still, connecting this to the bigger picture, analysts seem to agree with the undervalued idea, fundamentally speaking. There's a strong buy consensus from analysts covering the stock, and their price targets are, well, they're ambitious, around $7.50 on average.
Ron, from around $2 now, that's like 280% upside potential.
Exactly. So you have this massive gap, a super low PE, maybe artificially low, but also these very bullish analyst targets. It's a real point of tension for investors. Opportunity maybe, but definitely something to investigate further.
Okay, fascinating. Analysts are super bullish, market price is low. What are the charts telling us? The technical picture. The stock's 52-week range is wide, 1.175 above up to $5.83, currently around $2.07. And the 50-day moving average is just slightly above the current price, around $2.12. What does that suggest?
Well, the 50-day moving average is a common short-term trend indicator. When the price is below it, like it is now, even slightly, it generally hints at some mild short-term weakness. The recent momentum has been a bit negative.
Okay, a slight downward pressure maybe.
Yeah, sort of. And if we look broader, at market sentiment, the fear and greed index is currently showing fear. It's at 39.
So general nervousness out there.
Right. 0 is extreme fear, 100 is extreme greed. So 39 means investors are pretty cautious, anxious right now. That can sometimes mean things are oversold, but it definitely reflects current worry. Plus, you see some bearish price predictions floating around, expecting maybe a small dip, like 1.7% or so. And importantly, the stock has high volatility, about 45.59%. Which means, for every 1% the overall market moves, Sequans might swing almost 0.5%, up or down. So for you, the investor, high volatility plus that bearish sentiment, it equals higher risk, especially short term. Bigger potential swings are likely.
Okay, so we've got bullish analysts, but cautious market sentiment and some weak technical signals, a real mix. What's happening right now? Any news or catalysts that could shift things?
Well, the biggest thing on the immediate horizon is their Q2 2025 earnings report. That's scheduled for July 31st, so next week.
Crunch time.
Exactly. That report is going to be crucial. It's the company's chance to address the market's concerns, maybe validate the analyst's optimism, or, confirm the fears. People will be watching closely to see how the core business is doing, and if they explain that massive profit from before, a strong report could really move the needle. A weak one could hurt.
Makes sense. And longer term.
Right. Longer term, the big picture is still the growth in 5G and IoT. That's the underlying tailwind. As more things get connected via 5G, demand for their kind of chips should, in theory, grow. They also have specific projects like Monarch and Calliope. These are their platforms for advancing 5G IoT tech.
Right. Monarch and Calliope, what do they do?
So Monarch is really focused on low-power, wide-area stuff. Think smart meters, asset trackers, things that need long battery life. Calliope aims at higher bandwidth 5G IoT applications. These aren't just buzzwords. They're core R&D efforts trying to stay ahead in specific parts of the IoT connectivity market. Success here could definitely boost future performance.
Okay, so potential catalysts there. But every investment has risks, the shadow side. What should people be aware of here?
Well, this really brings us back to that core question, doesn't it? If analysts are bullish and the tech seems promising, why is the stock trading so low with this fear sentiment? That extremely low valuation combined with those odd profit margins. It just screams caution. You have to question the quality and sustainability of those earnings. Are they real repeatable profits from the business? And then there's the cash flow problem we mentioned. That inconsistency is a major concern for long-term health. If you're not generating cash reliably, how do you fund growth? How do you weather downturns?
Even without debt, cash is king.
Absolutely. And beyond the company specifics, remember, semiconductor stocks in general are famously volatile and cyclical. They swing with the economy, tech trends, supply chains. Competition in IoT is fierce too. Big players, nimble startups. It's crowded. There's always a risk someone develops a better, cheaper technology.
Technological disruption.
Yeah. And then you have the macro factors. Global supply chains are still messy sometimes. Interest rates, a slowdown in tech spending. All that can hit them. And finally, that high volatility we mentioned, 45.59%. It just means bigger price swings for you, the investor. It amplifies risk.
Okay, so a complex picture. Intriguing potential, but definitely some significant hurdles and question marks. So putting it all together, what does this mean for you, our listener? Our sources give Sequans an overall rating of 6.5 out of 10. How should someone approach this?
Well, based on all this, Sequans seems generally more suited for long-term investors, people who can stomach that volatility we talked about. You'd need to be willing to wait, betting that the 5G and IoT growth story plays out and that Sequans captures a decent slice of it eventually. It's not likely a quick win.
More of a patience game.
Exactly. For short-term traders, definitely need caution,
Yeah.
The bearish sentiment, the high volatility. It's risky. Now, the earnings next week could offer a catalyst, maybe an opportunity if they surprise positively, but you'd have to be very comfortable with that risk.
And if someone is considering getting in, entry points,
Yeah.
risk management.
If you're looking at entry, maybe somewhere around the current levels, perhaps slightly below, say the $2 to $2.10 range seems reasonable based on current technicals. If you are trading it, definitely consider a stop loss. Maybe 10–15% below your entry, somewhere near $1.75 perhaps, to limit potential downside. For taking profits, you could think in stages. Maybe aim towards some of those analyst targets, like $3.50 first, then maybe $5. But always watch the technical resistance levels on the chart. Overall, look, it's a speculative buy. It seems best suited for investors with a higher tolerance for risk and a medium to long-term view who really believe in that IRT narrative.
Okay, so there we have it, our look at Sequans Communications, a company with, yes, promising long-term potential, some signs of undervaluation according to analysts, but also some pretty significant risks, that inconsistent cash flow, questions about profit quality, and the current cautious market mood.
Yeah, and here's something really interesting to think about. You've got these wildly bullish analyst price targets, right? Way up there. But then you have the market itself showing fear and the company's own track record showing shaky cash flow. So how do you, as an investor, balance that fundamental promise against what the market is actually doing and saying right now? What specific signs would make you truly confident that those past profits weren't just a fluke and that the future growth is real? Something to mull over.
Definitely food for thought. Thank you for joining us on Investing Talk Podcast. We hope this exploration gave you some valuable perspective on Sequans Communications. Until next time, keep learning and keep investing smart.